Moving on to a highly anticipated Elliott wave course. And an awful lot of people reach out to me about this. What I've done is I've narrowed down all the noise and I've put practical examples of what we should be looking for in terms of wave structures. There's an awful lot in Elliott wave, and there's an awful lot of noise that I think you should ignore and zone out and just focus on the most probable patterns moving forward. So starting off, we'll have a look at the guidelines of Elliott wave. There's only 3. And then we're going to have a look at the personality of each wave. So we were looking at wave 1, 2, 3, 4, and 5. And then we'll be looking at wave A, B, C, D, and E. So we'll start off with the guidelines. Wave 3 is an impulsive. It's typically extended. We tend to have wave 5 and wave 1 of equal size. So you tend to have wave 1, typically say it moves 10%. You would expect that the wave 5 moves 10% also. For a wave 3, it's extended 1.618 times the length of that wave 1. In other words, it would be 16.18%. There are occasions when the wave 5 is actually the extended wave and not the wave 3. However, we tend to see that more often in currencies or commodities as opposed to equities. So keep that in mind when you're looking at a currency chart or an equity chart. You can see the final extended wave happen in the 5th wave as opposed to the 3rd wave. So the next guideline we have, if wave 2 is a sharp style correction, we tend to see wave 4 as a sideways correction. In fact, in most cases, that's how it is. Wave 2 is always the sharpest, wave 4 is always a sideways correction. However, if wave 2 is a sideways correction, you can see wave 4 as a sharp correction. So they can alternate in that sense. So be careful of that. So what we see in wave 2 should be the opposite in wave 4. The next guideline, when the market goes into a correction, it will often correct back to the prior degree wave 4, so of a lesser degree. So we'll show you a practical example of that with a chart a little bit later in the tutorial. So moving on to personalities of an impulsive wave, so the 5 waves up. So the first wave, half of the first wave price bases out, and then it tends to build on that to complete off a wave 1. Now wave 2, the correction is rather aggressive, and the characteristics of this are most investors are convinced that we're breaking back down into a bear market. So the second wave can retrace all of wave 1. Typically it comes back down to the 61.8% Fibonacci, but we can retrace 100% of wave 1, so we got to be very careful. And most investors think we're moving back into a bear market. So if you go back to the beginning of the bull market, March 2009 was the low, and we rallied all the way into 2011, 2012. At that point, we had the sovereign debt crisis in Europe, and then all markets started to break back down again. The S&P 500 dropped 19.4%, just shy of bear market territory, and we started to see the masses call for a double dip recession and that the markets are going lower. Now, when you couple Elliott wave with the macro top-down view, the two of them are a made in heaven match, because it's liquidity that starts off the bull market and not fundamentals. That's why most people that focus on valuations and economic fundamentals always miss the beginning of it and always miss the end of a bull market, because they're waiting for the economic data points to turn higher, and in theory all we need is liquidity to increase. And so that's what we tend to see when interest rates are reduced. So go back to 2007, 2008, and 2009. Interest rates went from 6% all the way down to 0, and you're seeing quantitative easing. That's massive increased liquidity, bull markets born, and you still have poor economic metrics. And so when we look at the personality of wave 2, it really correlates well with that macro top-down view, because the macro top-down view is telling us that liquidity is increasing but the economy is still poor, and the second wave you should see most investors calling for another bear market. So they correlate rather nicely. Then we break into a wave 3. Now wave 3 tends to be the strongest, the most broad rally that you see within the structure. And that's when the liquidity feeds into the economic data, and then you have everybody on one side of the boat. Everybody's happy with the market, and the market moves at its strongest point here for a wave 3. Almost all stocks in the index will participate in this third wave. From there we move into a fourth wave, and for the fourth wave we will revert back to this guideline where it's really dependent on how the wave 2 breaks down. Typically wave 2 is sharp, so wave 4 goes sideways, and you tend to see maybe a running flat or a triangle play out for a wave 4. We'll go through all that today. So it's typically building a base for that final boost higher for a wave 5, and in this moment you'll tend to see the lagging stocks of the cycle, they tend to peak out in a wave 4 and start to roll over and move lower, and that moves into the fifth wave. And this is the price action is less dynamic, the velocity of the price move is a lot lower, and this is when you start to see an awful lot of the weaker stocks roll over. Optimism is extreme. So right now, August 2018, everybody's calling for this new bull market that started in 2016. Optimism is extremely high, liquidity is being choked off from a macro level, and we're starting to see the breadth slow down a little bit. So this has got the perfect characteristics of a fifth wave. So right now we should be looking for signals to get out of the market. In other words, we need to be tactical. Moving on to A, B, C, D, E corrective waves. And so A, B, C are what we typically see. And then the D and the E waves, you tend to see them in a triangle for a fourth wave. So we'll start off with a wave A. So characteristics, this is when the public is convinced that this is just a short-term correction. They rush in and they start trying to capitalize on the drop, despite the increasing technical damage signals that we're starting to see. Then you see the B wave start, where price starts to rally a little bit. It retraces a little bit of the drop, and everybody starts to pile in thinking this is now breaking higher. This is where all the suckers come in. They start to pile in money, and then we start to turn lower. A wave C is almost always aggressive. It's an impulsive wave. It tends to break down in 5, unless it's a WXY pattern where it would break down in 3. But it tends to break down in 5, and it tends to be rather steep. And this is where the psychology changes. So for wave A and wave B, everybody's trying to catch a low. And then you get that C wave where the psychology changes because it's so sharp to the downside that everybody assumes that we're now going into a bear market. Baron Rothschild said it best: buy when there's blood on the street, even if that blood is your own. And we tend to see that blood on the street in a wave C, right in that final fifth wave within wave C. That's when we see the blood on the street, where everyone starts to say if it's an equity, it's going bankrupt, or if it's gold, it's a pet rock, or if it's crude oil, it's peak oil. That's where you start to see those crazy comments come out. So that's what you tend to see in a wave C, and it's typically a fantastic buying opportunity. So moving on to the triangle, wave D. And a very important characteristics of a D wave is actually the increase in volume. So if volume increases for this D wave, it tells us that the next move we should see is in that direction. We still got an E wave to come on the downside, but this D wave is giving us a signal that this is the direction of the wave. So don't worry if you're not following along. Once you see the chart pattern, an actual chart pattern that's currently breaking out of a triangle, this will all make perfect sense. And then finally we move into an E wave. So an E wave can be rather difficult because it can either truncate or it can break the triangle in the downside in a false fashion before shooting to the upside. Again, I'll show you guys a practical example of that in this tutorial. So without further ado, let's start looking at some actual chart patterns and some guidance before we start looking at real live examples. So let's start off very simple. Impulsive wave. What is an impulsive wave? 5 waves to the upside. Remember from the guidelines, wave 1 and wave 5 are typically of equal length, right? So if this is 10% up, we tend to see this final fifth wave at 10% also, in line with the wave 1. Now the wave 3 is typically the golden ratio of 1.618 times the length of wave 1. So if this is 10%, this should be 16.18% for a wave 3. That's what we tend to see. The retracements, so these can alternate. The 2 corrective waves are wave 2 and wave 4, and it can alternate. So if this wave 2 is sharp to the downside, we should see a sideways correction for a wave 4. Typically, we tend to see the sharp correction happen in a wave 2, and at the very least, we should be looking for a 61.8% Fibonacci, but do understand that this can retrace 100% of the prior degree wave 1. For a wave 4, that retracement is about 38.2% of this entire wave 3, but it can come down to 50% I wouldn't like to see it any deeper than that. And the characteristics of this wave will be determined by the wave 2. So from your impulsive move, what you'll find is on every time frame lower. So imagine that this big impulsive wave here is a weekly chart. And then we go down and look at the daily chart, we'll find another 5-wave impulsive move up here for that first wave. And the characteristics of these 5 waves are the exact same on every single time frame. And that feeds true for corrective waves also, A, B, C. And from the guidelines, A should equal wave C, but no longer than 1.382 times the length of wave A. So if wave A drops 10%, we should see wave C drop 10%. And at the most, it can drop 13.82%, but no further than that. Now let's get into different wave structures, starting at a wave 1, moving into a wave 2, then a wave 3, 4, and 5. So we'll start off with a wave 1. We can have what's called a leading diagonal. Now there's also an ending diagonal, however there's a clear distinction between both. They both have rising wedge patterns. Only a leading diagonal has 5 waves up for each impulsive move. The ending diagonal differs in the sense where every single wave is broken down in 3. However, with a leading diagonal, these impulsive waves are impulsive. They're 5 waves up, 5 waves up. And that's the difference between a leading diagonal and an ending diagonal. When we have these rising wedge patterns, be it a leading diagonal or an ending diagonal, the drop, it tends to be rather aggressive in for a wave 2. So we know then for sure that the wave 4 is going to be sideways consolidation. So that's the characteristics of a leading diagonal. Each impulsive wave breaks up in 5. Now let's look at other corrective patterns. So we'll start off with an A, B, and C, where wave A breaks down in 5, wave B breaks down in 3, and wave C breaks down in 5. This is the hardest wave to follow, and the reason I say that is because we have what's called a 1-2-1-2 pattern. And basically, going back to the chart pattern a moment ago, on each time frame you tend to see the same chart patterns break down for each wave. So when we get a wave 1 up, we get a wave 2 back down, then we start a whole new 5-wave pattern up for that wave 3 inside the wave 3. And when we've got a 5-3-5 pattern, what we could be looking at is a wave 1, a wave 2, and then a wave 1 within a bigger degree, wave 3. And so that makes a 5-3-5 pattern very difficult to follow. Now if you're a little bit confused, don't worry, because I've got a chart pattern to show you in just a moment. So the rules of a 5-3-5 ABC pattern are the exact same as every single corrective pattern. You want wave A to equal wave C, and no longer than 1.382 times the length of that wave A. So that's how we distinguish the length of a corrective pattern. And that's the hidden sign that would tell us that this is actually corrective. It's the length of wave A and wave C. So moving on to a 3-3-5 ABC correction. Much easier to follow because we've already broken down in 3, we've broken up in 3, and then we should expect 5 waves down for a wave C, an impulsive move. So this is a lot easier to follow because it started off from a corrective move, and we know that we have 3, 3, and then 5 to the downside. So moving on to what's called a zigzag, and this is a WXY pattern, and again, same ratios, W and Y of equal proportions, and no further than 1.382 times the length of W. Exactly the same as an ABC. The only thing that's different between a WXY and an ABC is this final wave here breaks down in 3, right? So you got 3, 3, and 3. That's how we distinguish a WXY zigzag pattern. But the characteristics are the exact same in terms of the ratio, W and Y of equal proportion. So now, back to the 5-3-5 pattern and the issues that I have with a 5-3-5 pattern moving forward. So if you can imagine, this would be a wave A, a wave B, and then a wave C. But this breaks up in 5-3-5. It's very hard to know whether this is a full wave 3 starting or this is a wave 1. It can be rather tricky. However, when we focus on the macro view and we focus on our fundamental analysis, it's very easy to have conviction in the trade and sit in this all the way to the top once you know the backstory. And so what I would say is, understanding the fundamental analysis and the macro view, which we'll get through this whole course, it'll be a lot easier to hold this trade and have conviction in it because you've got a higher probability that the outcome is to the upside versus the downside based on the data that we're following. So that's the only issue with a 535, but if you do the background work, you'll never get caught out on that issue. You'll always have conviction. So moving on now to a triangle pattern. So we've gone through a wave 1, we've gone through a wave 2, we've gone through a wave 3 a moment ago, 5 impulsive waves, it's the strongest wave. And now we're at a wave 4, which is typically sideways consolidation. So there can be two types of wave 4. One of them would be a triangle. The other one would be what's called a running flat. Let's start off with a triangle. So how a triangle breaks down is an A, a B, a C, a D, and an E. In order to understand the directional bias of a triangle, you need to focus on this D wave and the volume. If volume is increasing here, it's the first sign that price is breaking in this direction, right? So you get a hint here for the D wave, and then for the E wave, what I mentioned a moment ago, this can throw an awful lot of people off. It can truncate. And so what a truncated wave means is, as you guys can see, how I plotted this out, it perfectly tests the lower support zone. A wave E could literally stop here, and that would be a truncated wave where it starts to break higher. As well as that, it can also break to the downside, and if it breaks to the downside, it tends to shoot back up in the other direction. This D wave is what determines whether we should be buying this break of the wave or not. If volume is increasing on the D wave and this breaks to the downside, the probability is that this is going to move higher, and that's where we should focus. So that's a corrective triangle. What's important also to note is the structure of how it breaks down. A, B, C, A, B, C, A, B, C, A, B, C, A, B, C. So that is a perfect corrective triangle pattern, which typically shows up in a wave 4. The other sideways consolidation pattern that we can see is what's called a running flat. And these are very difficult because they throw absolutely everybody off course. The reason being is we start at this point here, we have 3 waves up for a wave A, and then we have 3 waves down for a wave B, but we break below our starting point. And then from there we start shooting higher, and then we go above our wave A, and then that's the end of the C wave before it starts to drop lower. So we threw people off course here, and we threw people off course here, and then we move in the wrong direction. So you often hear people say, stay away from the sideways consolidation. That's where traders go to the graveyard, and that is absolutely the case with a running flat. Tends to happen in a wave 4, sideways consolidation, so be careful of that. We will look at some examples of when a running flat pattern really catches an awful lot of people off guard. Moving on to an ending diagonal, and this is the last pattern we're going to focus on. So the ending diagonal is similar to a leading diagonal in the sense where it breaks up in a rising wedge. However, it's different in nature based on how it breaks up. We tend to see every single wave break into 3. So if you remember from a leading diagonal, a wave 1, a wave 3, and a wave 5, all the impulsive waves broke up in impulsive fashion. They were breaking up in 5 waves. With an ending diagonal, that's different. They break up in 3s. Every wave breaks in 3, and with a rising wedge, you tend to see a very sharp move to the downside. Now, guideline number 3 states that we tend to see, once the final 5th wave is complete, we tend to see a retracement back to the prior degree wave 4. So what you tend to see is a move back down to the prior peak of wave 3, a little bit of a bounce, and then we drop right back into the wave 4. That's what Elliott wave guidelines suggests. An awful lot of cases, if it's a bigger degree wave 2, it comes down a lot deeper. So that is the last pattern that we're going to look at. What's important to note is Elliott wave is all about pattern recognition. Don't get caught up in the theory behind it, because you'll start to lose track of why you own something, and it'll be all focused on Elliott wave. And I think Elliott wave is a tool that should be used in conjunction with something else. And from the first lesson, I'm sure most of you guys can already relate to that lesson, and based on the characteristics of a cycle and the fundamental moves in liquidity, and correlate that well with Elliott wave. And so when you stack up different aspects of investing, such as macro and fundamentals, the Elliott wave is a perfect tool to complement that. And so it works fantastic if you do the background work, which we're going to focus on. But do understand it's pattern recognition. So once you got your fundamental view, once you got your macro view, open 100 different charts. And if you don't see a pattern in the first 30 seconds, close the chart. At the end of those 100 charts, you will have, say, 5 or 6 charts put to one side, and then go through those charts in more detail. Break down the fundamental case for each stock or asset, whatever it may be, and really drill down. Because the minute you put your money on the table to invest, the minute you're risking losing it all. Right, so we need the probability to be extremely high. Put the work in before you put the trade on, and then sit tight for 9 months. Do nothing, right? Trade less. Do all the work before you put the trade on, and then do nothing. That's the idea in trading. You get paid to do less. It's the only career on the planet that you get paid to do nothing. Investment bankers only spend about 10% of their time actually trading. The other 90% is market making. Right? So you don't have to do much. You just need to do the right things. And Elliott wave can be used very powerfully in conjunction with macro and fundamental analysis. Without further ado, let's go have a look at some practical examples. So the practical example we're going to use is Walt Disney, because this chart really has it all. And the first thing we should do is open up a monthly chart of the stock that we're looking at and just have a brief look, and you're sure in the first 30 seconds to see a pattern. So as you guys can see, the first thing I can see is 1, 2, 3, 4, and 5. And so the question is, how does this fit in practically with my expectations moving forward? And so we start to plot out the chart. The only issue I have with this is we don't have a definitive starting point, right? So it IPO'd here, and that was probably somewhere in the middle of a wave 1. However, that's back in the 60s, and it doesn't really matter where we are, because we'll probably have a nice defined run since the 2009 lows. So what you need to do is you need to start mapping out everything that you see. So wave 1, wave 2, wave 3, wave 4, and you'd be expecting some wave 5. So get the bare bones of the structure in, 5 waves up, and then start filling in each wave, right? So 1, 2, 3, 4, 5 within wave 3, A, B, C here within wave 4, 1, 2, we're in the middle of wave 3 before we get a wave 4 and a 5 to complete the bigger degree final 5th wave, which should finish way higher here. So one of the rules we had, if we have a sharp drop for a wave 2, we should see consolidation for a wave 4, right? So 2-year drop here, 4-year drop here. So that remains consistent. From there, we've got a 1, 2, 3. We're in the middle of a wave 3. So after plotting all the symbols in a very basic manner, where we've come from and where we're going, we should zoom in on this wave here from the 2009 lows. And so the first thing that we see is this wave 1 up, wave 2, and then you see this wave 3. So as you guys can see, this is rather sharp and rather steep to the downside. So then again, guys, once we have that for a wave 2, a wave 4 should be consolidation. So this wave here always gives us indication of what's going to happen in the future. So wave 2 is very sharp down, wave 4 is sideways consolidation. Now this is clearly breaking into a triangle. And as you see that sideways consolidation, you should start to put up your trend lines just to get the structure of the trade. And from there, we'll zoom in even further and we'll try and build out this structure here to see where we're going and is it a good buying opportunity. So once we've zoomed in, it's extremely clear that this is a triangle. ABC here down for a wave A, breaks down in 3. ABC up here for a B, up in 3, ABC down here for a C, breaks down in 3, and then you see an A, B, C here for D. And what's really interesting is when we look at the volume, so for this D wave, you can see if we skip that part there, you can see the volume ramp up here. So volume ramps up on a D wave here, and that tells us that that is going to be the defined direction, because when we drop into this E wave, as you can see, the volume starts to trend lower and then we start to move higher, right? So this wave here, this D wave, told us that this is going to be the ultimate direction, but we still have an E wave to play out. Now, fortunately, this chart played out perfectly. It came right back down, tested the lower bounds, and now it's taken off. And so from here, we can clearly gauge that that was a fantastic buying opportunity around $99, $100, and we should be expecting much higher. The question is, how much higher? So we go back out to the weekly chart, and what we would expect for a wave 5 is the same length as a wave 1 in percentage terms. So as you can see, this is actually 188%, which is an extremely, extremely big move. Does that play out here? It doesn't really matter, because no matter what's going to happen, this is a perfect structure breaking to the upside, and the potential is there that we are going to hit 188% to the upside. So from right here, I would suspect that from here, there is a probability that this is going to move 188% to the upside. That would bring us massively to the upside. Now, what I've actually done on this chart, and this is actually a position that I hold, what I've done on this chart is, because that's such an aggressive wave, I've actually multiplied that 188% by 0.618, and I measured that out as a first wave target. And the reason being is because it's so extended, and where we are in the cycle, it would be hard for me to believe that we get 188%. That's not to say it can't happen. It absolutely can happen. Even at that, there's still upside potential of 108% based on that. So that should bring us up to about $195 to $200 on Walt Disney. And that's how you break down the structure. It all comes back to, why would you be long Walt Disney? So you go back to May of this year, and everybody was talking about how Netflix market cap had now outpassed Walt Disney, and how Walt Disney was a dinosaur because it went sideways for 3 years. And when you break down that noise and you actually realize that Walt Disney are actually entering the streaming content space, as well as that they actually own the content as Netflix don't, and as well as that you've got a chart structure like this. When you look at the fundamentals and the macros of every single idea, you get these high probability outcomes. This trade is now up 14% off the $100 entry mark. So it just goes to show, when you put all your ducks in a row and you get right down to it and you look at the charts, this is probably one of the most perfect Elliott wave charts I've ever seen. And it goes right back to the 1960s. It's perfectly in line, and this is a big picture view. So what you do is, you bought it on the 31st of March down at $100 and you own it. And you've held it for 2 months, you collected 14%, and you just sit tight. Knowing that the work that you've done is correct, you expect this to continue pushing higher, and nothing should deter you from holding this position. You just hold it, you've done the work, you sit tight, and you let it run up to $200 and you take your profit. And that's how we should approach every single trade. Put the trade on, leave it for 6 to 9 months, maybe even as far as out as 18 months, and allow the chart itself to pay us. Right, we've already done the work. So that is a real life example of how I implement those chart patterns. Start out at the monthly or the weekly or the daily, whichever you can get the biggest view from, and then work your way down right into a point where you can narrow in on a buying opportunity based on all the principles of Elliott wave, based on your fundamental and your macro for timing. So Walt Disney, fantastic chart, just a beautiful chart to learn off. Another example we can look at is the running flat. So this is very relevant, S&P 500. And you look at S&P 500, we have 5 impulsive waves down, meaning trend change. And from there, we should expect 3 waves back up before we start to roll back over. If you look at a running flat correction from the outline, it tends to send people in the wrong direction twice. So it breaks down below this wave here, and you think that this is a correction in, and we're on our way for a wave 3, and it tends to shoot back up in the other direction. Breaks above the wave A, and it tends to get people all on one side here before it tops out and starts to move lower. Now, it remains to be seen if that's how this plays out, and that's why you don't chase positions. You just wait patiently until you get that perfect spot to get into. And so for right now, what we should be looking for is a little bit of weakness here, start to roll over, but we absolutely do not want it above this area right here, because then the chart pattern is absolutely wrong. You cannot have a wave 2 that goes higher than the prior degree wave 1 down. The risk is entirely defined here, but this is a perfect running flat pattern in Elliott wave, and it could see this price move lower. Now we'll just have to wait and see. This is a very short term, and it also displays how these patterns appear on all time frames. They appear on all time frames across the board. This is one example on the 1 hour chart. We just looked at the monthly, weekly, daily chart of Disney, and it doesn't matter what you're looking at, everything has the same structure and the same rules apply to each structure. So this could be a running flat, very difficult pattern to gauge. However, it's absolutely relevant for where we're at right now. So that's another example of a running flat that we looked at. If we're to now move over and look at emerging markets, EEM, and we look at the cycle from 2016 that began, and as you can see, a 5-3-5 movement, and this is where it gets rather difficult, and this is the point that I was trying to make with the 1-2-1-2 pattern. So right now you got 5-3-5, and that could be corrective. almost of equal proportion, and it could roll over and make a new low. And this is why it's so important to have your fundamental and your macro view in order to be able to determine that this is a buying opportunity and this is a holding opportunity. You don't sell in this, you continue to hold, and you keep holding until the scenario changes. And that brings you right up to $50. So you make the most amount of money by doing the least amount of work. Now, it does require a little bit of work, about 15 hours a month to get all these ideas down to a T. And then once you put it on, you find the pattern on the chart, you commit to it. You don't have alternate counts. Alternate counts are silly. And you commit to the chart and you sit tight, knowing that the work that you've done is correct and the probability of the outcome is going to be a lot higher because you've factored in everything across the board: macro, sentiment, fundamentals, and finally your chart pattern. So that's how a 1-2-1-2 pattern can throw us off, because they're almost of equal length, and it's a 5-3-5 pattern, which could be an ABC also before we break back down. So of course, if we can have conviction in our trades, it's a lot easier to hold and suggest that this is a 1-2-1-2 and not an ABC. So next, let's have a look at copper. And copper, this is a perfect example of marrying macro view, the macro top-down view, with Elliott wave. Because we knew for 10 months before inflation turned that inflation was going to turn. And in doing so, we could have bought inflation-sensitive assets back in 2016, and we could have just held them, knowing that inflation would continue rising. So if you bought this back in 2016 during this volatile pattern right here, or on the breakout, you've got a high conviction that this is going to pay off dramatically over the next couple of years. And just by doing those small things like updating one chart on the velocity of money, it can determine where you're going to go at some point in the future. And then when you marry it with ideas like buying copper, represent that higher inflation trade, you start looking at chart patterns, and the chart patterns start to stack up, and you've got massive conviction that over the next 10 months in 2016 and continuing forward, that you're going to have heightened inflation and copper is going to be a beneficiary. This is also a fantastic chart to represent that final fifth extended wave. Typically, we tend to see the third wave as the extended wave. However, with currencies and commodities, it's quite common to see a fifth wave being extended. So this is all of wave 3, 1, 2, 3, 4, and an extended fifth wave for wave 3. All that needs to occur is that wave 3 is not the shortest. That's all that needs to happen, and that's very clear here. 1, 2, 3, 4, 5, and then we've got a perfect flat correction. 3, 3, and then 5 down. So I would count that as a wave 4 in. Perfect flat correction here, ABC, 3, 3, 5 ABC pattern here for copper, and we should be on our way to a new high to complete off this full structure that happened in 2016. Now, we know that inflation is set to continue over the next 10 months because we've already done the macro view work. Lesson number 1, we looked at ISM and we also looked at velocity of money, and both of them are indicating higher inflation over the next 10 months. So that bodes well for copper. And of course, in the short run, you are going to have these corrective patterns irrespective of the macro view data, but it's supportive moving forward long term. And if we can capture these moves, we're going to make an awful lot of money over a longer period of time. So that's how easy trading can be when you marry a couple of different disciplines together to get a final outcome with a higher probability. Very simple. Update a couple of charts and then take a couple of hours just to think about it, a couple of hours to yourself. Pop into your office, take out a notepad and a pen, turn your phone off, write down what you think might happen, and then go and start looking at charts. Break down the charts. Very, very, very simple. So with that said, that's just a couple of examples of how we use Elliott wave and practical examples of how it works out. It, as I said, it marries extremely well with our views on macro top down and also fundamental bottom up. The probability increases dramatically when you put it all together. So hopefully after this tutorial, you guys will be able to understand exactly what I'm saying. And as we go through each PDF at the beginning of each month, I would love for you guys to start finding ideas and putting them into the group, and we'll refine them as a group. But more importantly, what that's going to allow you to do is get practical experience. This course will end in 9 months, and you've got an opportunity to come up with ideas, learn it practically, get into good habits, and I can overlook them for you and give you my honest opinion based on the experience that I have. And so this is a fantastic opportunity to start getting in good habits of doing this work yourself. Otherwise, your process is not going to be autonomous, and you're going to be paying me for a very long period of time. And that's not the point of this. The point of this is so you guys can walk away and in 15 hours a month, you'll be able to generate fantastic ideas. Have full conviction in it, know why you own it, and sit tight and collect your checks every single quarter. So that will end the tutorial on Elliott Wave.